Hello everyone, welcome back. We are solving accounting paper 1. So this is May-June 2025 paper 1-1. This is the third part of the video, so we are solving from 21 to 30. So without delay, let's get started. Question 21. Which statement about ratios are correct? Number 1. Ratios are affected by accounting policy. Ratios can be compared with the industrial average. Ratios generally ignore inflation. And ratio includes non-monetary items. So first one, ratio affected by the accounting policy. That is definitely true. If we change the accounting policy, then it will also have an effect on the profit or the value of the assets or liabilities in the business. So ultimately, our ratio would get affected. Then ratio can be used to compare the data either with the previous performance of the company or with the other business in the similar industry. And then third one, ratio generally ignores inflation. Yes, it does not take into consideration time value of money. It will simply tell you what was the ratio 10 years back and what is the ratio now, or what is the ratio last year and what is the ratio this year now. Okay. And then the last one, ratio includes non-monetary items. Ratio does not include non-monetary items because it will include only the monetary value into consideration. How much asset business has, how much profit we made. So non-monetary item will not be included. So the correct answer for 21 is 1, 2 and 3, which is A. 22. A limited company achieved a return on capital employed 5% for the previous financial year. The following additional information is available. Equity 1 million, 10% debenture 200,000, finance cost 20,000 and tax 10%. What is the profit for the year of the company? So for this we need to calculate return on capital employed. So let's do that. Return on capital employed is very simple. So profit from operations, and this would be divided by capital employed and into 100. I'll just write down this one here, into 100, and it should give you equals to 5. Okay. Sorry, equals to does not come here, so I'll just write it here, and then this is 5. So let's replace this value. Profit from operation we don't know, so we'll just call it profit. Okay, and the capital employed is equity plus non-current liability. So 1 million plus 200,000, so 1,200,000, and then it will be multiplied by 100 equals to 5. So let's cross multiply this one. So when we do cross multiplication, 1,200,000 will be multiplied with 5 and then we'll divide by 100. So this is your profit from operation is equals to 5 into 1,200,000, and then this will be divided by 100. And the final step, let's calculate that. Profit from operations is 5 into 1,200,000 divided by 100, and we are getting 60,000. Profit from operation is 60,000, but company, they are asking us what is the profit for the year. So we need to subtract finance costs and taxations that was given to here. So this is your finance cost, which is 20,000, so minus 20,000, and then the tax, that is minus 10,000. Okay, and when we subtract this, which is 30,000 out here. This is my profit for the year. Okay, so correct answer for this question 22 is B. Next one, 23. A business rents machine for use in its factory. The rent cost of machine is 12,000. Each machine has a capacity to produce 60,000 units. The business provides the following information. Number of units 90,000, 120,000. The total cost excluding rental cost of machinery 510,000, 600 and 60,000. What is the total fixed cost to produce 100,000 units? Okay, so let's analyze this one. We are producing 90,000 units and we paid 510,000, and this 510,000 includes both fixed cost and variable cost, but in this it does not include the machine rent, which is also another fixed cost. So first we calculate how much fixed cost is included in this, okay, and then add the rent of the machine to calculate the total fixed cost. And this is simple. Okay, first what we'll do is we will look at how much is our variance out here, okay, or how much is my variable cost included at this production. So 90,000 we are producing, and then 120,000 is now what we are producing. So if you look at here, the difference that we are getting is 30,000. So we make 30,000 units, and why I'm doing this is I want to calculate what is the difference in the cost as well. So cost difference is 510,000 divided minus 660,000. Now if I do that, then this will give me the cost of producing 30,000 units. Okay, so I was producing 90,000 units, now I produce 120,000, so extra unit I produced is 30,000. I was paying 510,000, now I am paying 660,000, so extra cost that I paid is 150,000. So the cost that changes along with the output is called variable cost. So for 30,000 I am paying 150,000. That means my variable cost for one unit would be 150,000 divided by 30,000, and that is $5. Okay, for one unit variable cost we are paying is $5. So my total variable cost for 90,000 unit will be 5 into 90, and that is getting 450,000. If this is my total variable cost, and I can easily calculate my fixed cost. Okay, so fixed cost is, if I subtract variable cost from the total cost, I'll get fixed cost. So total cost that I'm paying is 510,000. So my fixed cost is total cost minus variable cost. Fixed cost is 60,000. Okay. Now fixed cost does not change with the output, no matter what the level of output is, either 90,000 or 100,000 or 120,000. Okay. If I calculate in 120,000 unit as well, I'll get the same fixed cost. Let me just show you here. Okay, so total variable cost for 120,000 units is 5 is per unit, and then we are making 120,000 units. So total variable cost we paid is 600,000, and total cost we paid is 660,000. So total cost minus total variable cost will give you fixed cost. So my fixed cost out here is 60,000 again. Okay, now we already calculated the fixed cost included out here, but this fixed cost does not include the rent of the machine. Okay, and they say that the rent for the machine is 12,000, but each machine will produce only 60,000 units. So in order to produce 100,000 units, I need two machineries. So that means 24,000. So 60,000 is the fixed cost included here and 20,000 for the machine. So altogether we paid 84,000. For answer 23 is B. Let's go to 24. A company sells a product for $12 per batch. The variable cost is $4 per batch. Fixed costs are observed based on the normal level of activity, which is 100 batches at $3 per batch. And we need to calculate what is the profit under marginal costing if company makes and sells 125 batches. So, as per the marginal costing, we will have selling price. Okay, so selling price in this case is 12. And then we need to calculate variable cost. Variable cost in this question is given 4. And then we need to calculate fixed cost. Okay, fixed cost out here they said it would be observed for 100 batch $3 each. So 100 and $3 each. So total fixed cost that we are paying is this into this, which is 300. Okay, I hope you understood this. Now, whenever we calculate profit using the marginal costing, we need to calculate contribution. Okay, and contribution can be calculated when subtracted variable cost from fixed cost. Sorry, variable cost from selling price. So selling price minus variable cost will give you contribution. And this is contribution per unit because this is a selling price per unit and variable cost per unit. Okay, this is contribution per unit because it is the selling price per unit, variable cost per unit. So obviously contribution is also per unit, which is 8. Okay, I want to calculate my total contribution, and total contribution is total unit we are making is 125 batches. So contribution out here is $8 into 125 batches. That will give you $1,000. So in total contribution, if I subtract fixed cost, which is 300 we got, then the difference is our profit as per marginal costing. So selling price minus variable cost will give you contribution, and if you multiply that with the total output, then it will give you total contribution, and from that total contribution, when you subtract fixed cost, you will get profit. Okay, it is 700. Now you can also do something like this. We can also find out total selling price, total variable cost, and directly skip contribution per unit part and calculate total contribution directly. Okay, if I do that, then 12 is a selling price per unit per batch, sorry, and then we are making 125 batches. So total sales is 1500. Variable cost per unit per batch is 4, and we are making 125 batches, so 500. Selling price minus variable cost will give you contribution, and that is 1000 again. And in that 1000, if you subtract 300 fixed cost, then 700 is our profit. So for this question number 24, your correct answer is C, 700. Let's move on to the next question, 25. Which statement correctly compares the benefit of absorption and marginal costing? Let's look at that. Absorption costing, A, avoids the need to separate fixed cost and variable cost. Absolutely true. Okay, when we use absorption costing, we do not separate variable cost and fixed cost like marginal costing. We just take into consideration direct cost and overheads and calculate the production cost. So correct answer is A for the absorption costing. Let's see if that is also true for marginal costing. So in marginal costing, useful when there is limited factor affecting the production. Yes, when we did a question or problem in marginal costing, we learned that there is a one aspect which it will help us, that is limiting factors. For example, if we have less number of labor hour available, or if we have less material available to produce product, then marginal costing will help us to calculate what is the optimum utilization of those resources so that we can achieve maximum profit. Okay, if you remember that sum, I'll give example. Let's say you are producing product A, B and C, and now to produce all the unit for A, B and C you required 1000 labor hours, but somehow this month we don't have 1000 labor hours, we have only 900 labor hours. So how we plan our production so that our profit is maximized? So that process is, or that's is called limiting factors, or optimum utilization of limiting factors. Okay, and marginal costing will help us in that. So for 25, correct answer is A, so we don't need to consider B, C and D. 26. The following table shows details of production for a week. So this is budgeted production overhead 100,000, actual production overhead 80, expected production is 5,000 units, and over absorption of overhead is 10,000. Now before I solve this question, let's understand what is over absorption. Okay, so over absorption is when your budget is more than the actual expense or actual overhead. That is called over absorption. Now in this case, if you look at here, my budget is 100,000 and my actual production overhead is 80,000, so it is exceeding by 20,000. So my overhead absorption should be 20,000, but they are saying it is only 10,000. It means that the actual production output level is less than 5,000, because this 5,000 is the expected or the budgeted production output. So my actual output is less. So we need to calculate what is that actual output for this week. Okay. And this is very easy to calculate. So first let's calculate how much is my budgeted overheads. Okay. So budgeted overheads out here should be 90,000 and actual overhead is 80,000. In that case, when I subtract actual overhead from budgeted overhead, I will get overhead absorption or over absorption of overhead as 10,000, right? So let's do that here. So this is your budget. Budget should be 90,000, and in that, if we subtract actual of 80,000, then my over absorption should be of 10,000. Now this is the valid condition in that. Okay, there's a number of ways that you can do it, but I'll use the easiest method to calculate the unit. Okay, so if we are making 5,000 units and then we spend $100,000, or we plan to spend $100,000 to make it, so how many units we should make to spend $90,000? Okay, do the cross multiplication and you'll get your answer. Okay, so cross multiplication is, so x equals to 5,000 into 90,000 and this whole divided by 100,000. I'll write that number in equation now, and we are getting 4,500 units. So we have to produce 4,500 units in order to get 90,000 as my budgeted cost, and when I subtract that actual cost from the budgeted cost, I'll get the over absorption of 10,000. So your production for this week is 4,500 units. Answer for question 26 is C. Okay, 27. A business has produced the following budgets. Revenue 700,000, contribution 560,000, fixed production cost 350,000, and fixed non-production cost to 20,000. What is its break-even revenue sales? Okay, so in order to calculate break-even revenue sales, first we need to calculate break-even point, and break-even point can be calculated with this formula, which is fixed cost divided by contribution per unit. Now in this question we don't have contribution per unit, so there are two ways that you can solve this. Let's use the easy method first, and then we'll do the assumption method second. Okay, so first let's calculate the fixed cost. Fixed cost is the total fixed cost. We have 350,000 plus 20,000, that will give you 370,000 is my total fixed cost. And let's divide this with the total contribution. Normally we need contribution per unit, but that information is not available to us, so we'll use total contribution of 560,000. Okay, now this will give you a number. Okay, and that number is a break-even unit, and we'll multiply that with the revenue to calculate the break-even revenue. So my BEP out here is 370,000 divided by 560,000, will get a number, and let's multiply this number with the revenue, which is 700,000. Let's write down this somewhere here, and then we'll write down BEP sales. And BEP sales is, sorry about that, BEP sales is contribution break-even units into total revenue, and then we get 462,500. Let's try the next method, which is the assumption method. Okay, let's assume that we produced and sold units as 1,000 units. You can assume any number. I'm just doing this for the ease of calculation. Okay, let's calculate sales per unit. Okay, sales per unit, we are making total revenue of 700,000, and we assume we made and sold 1,000 units. So 700,000 divided by 1,000 will give you sales per unit. Okay, so that is 700. So now let's calculate contribution per unit, and the contribution, total contribution is 560,000 divided by total unit produced and sold is 1,000. So we'll take that and calculate contribution per unit. So contribution per unit is 560. So let's calculate BEP, which is total fixed cost 370,000. Okay, 370,000 is 350 plus 20 divided by 560, which is the contribution per unit, and this is my break-even unit. So in order to calculate break-even sales, we'll multiply this unit with the selling price per unit, and BEP sales is unit, break-even unit into selling price, and that will give you 462,500, same as the first one. So whichever is easier for you to understand, you can do that. So for 27, correct answer is D. Question 28. How is the margin of safety calculated? Okay, margin of safety is a difference between the actual sales minus break-even sales. So here total sales unit minus break-even sales unit is your margin of safety. Okay, let's go to 29. A business has a contribution to sales ratio of 40%. The following information is available. Sales revenue 100,000, fixed cost 30,000 and profit 10,000. So it is predicted that sales revenue will increase by 20% next year. Total fixed cost will remain unchanged. What will be the increase in the profit? We can also use the contribution to sales ratio to calculate the contribution first, and then from there we subtract the fixed cost to calculate the profit, and we'll get the same profit as we know. Okay, but there is an alternative to that. I'll show you both the ways. Contribution to sales is contribution divided by sales will give you 40. Contribution divided by sales should give you equals to 40. Now contribution we don't know, so we'll just name it X, and the sales amount is given 100,000. Okay, this is your 40% and this is equals to 40%. Now let's do the cross multiplication. Okay, so X, which is a contribution, I'll just write down contribution instead of write down X. Contribution is equals to 40% of 100,000. Okay, so 100,000 into 40%. Now if I calculate this number, then I'll get 40. Okay, this is my contribution. How do I calculate contribution? Selling price minus variable cost will give you contribution. Okay, selling price we already know is 100,000. Contribution we just calculate, which is 40,000. That means my variable cost should be 60,000. Okay, I calculated that this way. Other way we can calculate the contribution or the variable cost is, just look at this table out here. Sales or the revenue is 100,000. Now in this 100,000 I need to subtract fixed cost and variable cost to calculate profit. Fixed cost is given 30,000. Okay, how much more should I subtract from here so that my profit becomes 10,000? Okay, so 100,000, and if I subtract 60,000 more, that will be total 90,000 subtracted from 100,000, so I'll get profit of 10,000. So this is 60,000 here. Now once we calculate the variable cost, real solution begins now. So they are saying that revenue will increase by 20%. Okay, so if this is increased by 20%, then the new revenue would be 20% of this is, what happened, into 20%, so which is 20,000. So the new revenue would be 120,000. As question said, fixed cost will remain unchanged. So fixed cost will still be 30,000 here, but variable cost changes because we are selling more units, we need to produce more, so variable cost obviously changes, and it will also change by exactly same proportion as the sales because we need to produce exactly 20% more. So 20% of 60,000 is 12,000. So when you add, total would be 72,000. Okay, so I have a fixed cost, I have a variable cost out here. If I subtract these two costs from the revenue, then I'll get the profit. So revenue minus fixed cost minus variable cost, and the profit is 18,000. But remember, this is not the answer. Question was asking you what will be the increase in profit. So last time we have profit of 10,000, now it is 18,000, so it will increase by 8. So right answer for 29 is A. Okay, last question. The actual output of business is lower than forecast. Which costs are usually the same as forecast? So if your actual output decreased, then the forecast. Let's say we are planning to produce 100 units, we made only 50 or 70 units. So which cost will remain same out here? One is fixed cost per unit. Fixed cost per unit will not remain same, it will change when the output changes. Total fixed cost will remain same. Total variable cost will not remain same because it will change as per the output, but the variable cost per unit. Understood this? Then the right answer is 2 and 4, which is option C. Let me show it to you how it is. Okay, so let's say my total fixed cost is 500, okay, to produce unit as 100. Now even if I produced only 80 units, my total fixed cost will still be 500, but my fixed cost per unit will change. Let's see. So total fixed cost is 500 divided by total output. So in this case this is 5, but out here when the output decreases, the fixed cost changes. Okay, and the variable cost, we know that variable cost per unit will remain same no matter what. So if my variable cost is let's say $2 per unit, if I make 100 unit or 80 unit, variable cost per unit will remain same. Okay, let me just denote it here: total fixed cost and variable cost per unit. But the total variable cost will change. Okay, because it is as per the output. So this is 200 out here and this is 160 out here. So right answer for question number 30 is 2 and 4, which is C. Okay, with this we come to the end of this paper. We will solve more paper from 2025 May June, paper 1, 2 and 1, 3. Stay tuned for that. Till then, happy learning. Have a nice day.